Good morning or afternoon, depending on where you're joining us from, and welcome and thank you for joining today's webinar, Anti-Money Laundering Requirements for Real Estate Developers, Brokers, and Representatives. My name is Haley Howe, Senior Manager Forensics, and I'll be presenting with Lee Thiessen, National Leader Real Estate and Construction for MNP, and Greg Draper, Vice President Forensics, Valuations, and Litigation Support for MNP. You will have the opportunity to submit questions throughout the webinar using the platform. And in the interest of time, we will be following up with a blog posting addressing any questions that come in that can be viewed on the mnp.ca website. And details on how to access this will be provided after the webinar. This webinar will also be recorded, and instructions on how to access the recording will be provided to all participants upon completion of the session. So with that, I'll pass it over to Lee for his introductory remarks.
Thank you, Haley, for that kind introduction, and thank you to our external audience that has dialed in to this webinar. Much appreciated. I thought I'd give you a little bit of a background on MNP's real estate construction niche across the country. MNP specializes in servicing both high net worth private clients as well as public real estate clients. We have a host of services from core services on audit and taxation through to our advisory services. And in particular, MNP this year has been focusing on some risk management topics, that being cybersecurity, taxation services relative to the changing environment that we're seeing our federal and provincial governments tax our clients at. And today, anti-money laundering, which is the reason that we've all dialed into. Very interesting to see the change right now, and I don't think you can go inside the media without seeing the sound bites. In particular, in Vancouver, as we've seen the federal and provincial governments start to introduce brand new legislation to mitigate risk, and that's the very reason that we're meeting today. So with that, I'm going to turn it over to my partner, Greg Draper. Greg Draper is our Vice President for Valuations, Forensics, and Litigation Support National. Greg, thanks for joining us, and please take it away.
Thanks very much, Lee, and welcome to everybody on the call. As you can see from that bio shot on the screen, my past life prior to joining MNP, I worked as a senior investigator with the Royal Canadian Mounted Police, and a good chunk of my time there was spent in the proceeds of crime unit. So from an anti-money laundering perspective, I and others on our team bring a real-world perspective to this issue. So I spent a good piece of time investigating organized crime, taking away the profits from those activities. So the bags of cash, the houses in the Caribbean, the fancy sports cars, the businesses. And I was working on that unit when 9/11 happened, and we did a quick pivot as a federal police force to anti-terrorism financing. So those sorts of real-world experiences are one of the things that we pride ourselves on at MNP in a wide range of service areas and industry niches. So I'm happy to work with a large team of forensic accountants, law enforcement investigators, and forensic IT specialists across the country, reacting to a wide range of unexpected and unwanted events, including the intersection of criminal organizations into everyday honest businesses like your own. From the specific on the anti-money laundering compliance side, which is the day-to-day regulatory obligations that each of you face, I'm pleased to introduce our main sort of keynote speaker for the day today. Is Haley Howe. So Haley's based in Vancouver, which is a current hotbed for the issue that we're talking about today. Prior to joining us here at MNP, she had senior compliance roles in one of the world's largest money services businesses and a large Schedule II Canadian bank, looking after compliance efforts across North America and the Caribbean. So Haley also is a founding member and a co-chair of the Certified Anti-Money Laundering Specialist chapter in Vancouver, and sits on the federal government's Department of Finance task force related to anti-money laundering and anti-terrorist financing. So Haley has great things to say. Every time I speak with her, I learn something new in this subject, and looking forward to hearing what she has to say today. So Haley, thanks very much.
Thanks very much, Greg and Lee. Hopefully we're going to learn something new again today. So as Lee and Greg have said, the purpose today is to raise awareness of requirements, give some context to hopefully make things make sense a little bit, give you some things to think about, because that's certainly something that we want to do is, have something that you take away to ponder and figure out how you can implement within your businesses. So some of those things to think about would be red flags and STR reporting, suspicious transaction reporting. We're going to cover a lot of information, so we're going to try to keep things high level, but would be very, very pleased to discuss any specific concerns and questions and how we can assist you after the webinar. So a quick overview of the agenda. We're going to talk about what is money laundering, just to make sure that we're all on the same page. How is money laundered through real estate? I think that sometimes there's a misconception that money laundering only includes cash, so hopefully we'll be able to dispel that today. How does it affect the real estate industry in Canada? Who creates these regulations? So who do you have to be angry at? What are the penalties for non-compliance? So I thought we would start at the worst case scenario and work our way backwards to the good stuff. What do I need to do to comply? The FinTrack exam, because there's been a lot of attention on increased scrutiny of the sector with FinTrack. Available assistance and resources, and questions. So as I mentioned before, the questions on the platform, you can put those questions in, they'll all be gathered, and then we will be answering those questions afterwards. So let's start with the what is money laundering. So this is actually the UN definition of money laundering. So even though there's a lot of talk, I just wanted to start today's session by making sure, as I said, that we're on the same page with regards to the concept of money laundering and how it happens. So a really simple explanation is this. A bad guy gets money from a crime, and that crime can be drugs, it can be prostitution, it can be organized crime, so a crime. But he can't use it because the bills are marked, or they can be traced, or it will just look really suspicious if he starts to use all this cash. So he has to put the money through some kind of process to make it look like it came from a legitimate source. So just one note, typically when we talk about money laundering, we also talk about terrorist financing. But for the purpose of the webinar and in the essence of time, we're going to talk about money laundering. Terrorist financing is very limited in the real estate sector, so it's not going to be our focus today. So there are 3 stages to money laundering. The first is placement. This is what most people think about. This is the cash that goes into the laundromat and gets cleaned. So while quite often this does happen at banks, money service businesses, casinos, accountants, lawyers, which are reporting entities, the lawyers are a little bit complicated, cash can also be taken to, for instance, high-end car dealerships, art dealers to get the funds into the system, and criminals can also use real estate as a way to get cash into the system, although not as commonplace. It could be used for down payments or be provided to real estate representatives to provide to a lawyer to assist in the closing. So layering, which is the second stage, this is where the ownership of the money and how the money is actually tied to the criminal starts to get obscured, and it can be done through multiple transactions, through third parties or corporations, wire transactions between domestic and foreign accounts, foreign exchange transactions, which kind of break the transaction cycle, movement between accounts, and purchasing of high value items, hello real estate. And then the integration is where that money comes back out to the criminal and it looks clean. So the sale of flashy cars, as Greg was talking about, real estate, where now they've got a check and can take that money elsewhere and the money looks clean. So how can this be done in real life and through real estate? So as you can see here, there's a number of examples. I just wanted to touch on a couple of them. And as we go through these slides, again, start to think about, do I have any clients that potentially have done these kinds of things, which I may want to go back and have a look at. So manipulation of property value. So you can have undervaluation or overvaluation. So this could be when a purchaser wants to purchase a property and they say, hey, what I'd like you to do is put a value on the purchase and sale agreement that's quite a lot lower than the value of the home. And I'm going to make a side deal with the actual seller and I will pay them cash or I will get money to them somehow. So this is how you would undervalue a property. So the purchaser may also offer to compensate the realtor for their commission fee in cash or gifts. So alternatively, the purchaser could put an offer in on a home that's well over the property value, and then they would go and obtain a mortgage for the full amount. So they've got that extra cushion, if you like, through the mortgage. The seller provides the overpayment back to the purchaser, and after a few monthly payments on the mortgage, the purchaser will then pay off the mortgage. Or similarly, the same property is sold in quick succession to confuse the audit trail. So each time with a higher purchase price. So this could look like what's known as shadow flipping, or it could be actual sales. So person X sells to person Y sells to person Z, each time at a higher price. So another item that, and keeping in mind that sometimes the real estate agent or the developer is not privy to what's going on with the client, but some things to keep in mind, because I know that people have their ears to the ground. If you've got a client that's looking for a home to be renovated above and beyond the neighborhood, and they're paying with for the renovations with cash, this is something to kind of think about, is this how they're getting rid of the cash? And another issue which keeps coming up again and again in the media is this overseas ownership. So this is the method that's most commonly used by corrupt public officials and tycoons and organized crime. So what tends to happen is these groups will establish a shell company in a weak regulated area or a highly corrupt country, and then they use the shell firm to buy property in another country that doesn't require the presence of the buyer within its national borders to hold the property. So who actually loses when all of this stuff happens? Well, it's definitely the people who buy in the neighborhood or are currently living in the neighborhood, because they end up with completely skewed ideas of what the comparables are for their property values. Also the people who are victims of the initial corruptions, which could be anything from bribery to fraud or much worse. So, it isn't always the seller that wants to agree to accept this cash when the payment amount is lower. There can be a lot of coercion that's going on. The real estate industry can also be affected as consumers lose confidence in the industry when they start to see all the negative press that goes on. So what can be done to protect the market and you guys as professionals? So this is where we start to talk about compliance. So the Department of Finance has determined that real estate developers and real estate brokers and representatives are covered by the Anti-Money Laundering Act and the regulations for Canada. So there are particular definitions to determine if you're a covered entity, and covered entities then have to have the whole compliance program, the whole shebang. So what I wanted to do now is just cover off those definitions to make sure that we've got the right people on the call. It's like when you get on a plane and they check to make sure that you're on the right flight. So real estate developers, we'll start there as it's a little bit more complicated. The AML requirements apply to you when you sell to the public. So that's one of the main things to keep in mind. You sell to the public. So that would be selling a new house, a new condominium, a new commercial or industrial building, or a new multi-unit residential building. So the magic number to remember is 5. So it's 5 residential sales in a calendar year, or 1 commercial or industrial building. So in the context of real estate developers, sales to the public includes those to individuals or a corporation or any other type of entity, but it excludes those between affiliates and between subsidiaries and its owner. So a new house or other building is one that was constructed within the past 2 years and was not occupied for its intended purpose before being sold. So for example, a home is occupied by a developer as a sales office. That would still qualify as a new home as long as it's sold within 2 years of being built. So just to kind of take out all the words and numbers, if you're a real estate developer, you've sold the number of properties and you sell to the public, yes, you need a compliance program. If you don't sell to the public, so you go through a broker to sell all your units, or you haven't sold that many units, then you may not require a compliance program. So just for clarity, if you meet the requirements to be considered a reporting entity, it's from that point on. So for example, if you were to sell your 5 residential units by June 2016, for the rest of that year and actually kind of till the end of time, you're now considered a real estate developer for the purposes of the Act until you can show that there's been material changes in your business. Brokers and sales reps, a little bit more straightforward. So if you are licensed to buy or sell real estate, then you're covered and you would need an AML program. So in the instance where a broker or sales rep works for a firm, it's the firm's requirement to have the compliance program rather than the individual. Except for when it comes to reporting suspicious transactions, then both parties have responsibility for this. So what I wanted to do here is just kind of show you where all these rules come from. And as I said at the beginning, so you know who you should be mad at. So the Financial Action Task Force, which is the little circle at the top, this is an intergovernmental body which was established in the late 80s. And they're responsible for developing policies around anti-money laundering and anti-terrorist financing. And while these guys aren't really government, they have a strong organization that's made up of 35 member jurisdictions, 2 organizations, and they're very, very influential. So when they come up with the standards, and it's basically global standards, they then generate the necessary political will to implement changes or ensure that the current regime is effective. So they will go through these 35 countries and they do compliance reviews at the country level. So you think that you get hit hard by FinTrack. These guys are looking at the government, the legal system, how things are done. They look at how many convictions have been done on anti-money laundering or money laundering activity to determine if the whole thing is effective. So the ramifications of not meeting these standards can be severe. So it can include increased risk assessment for the country, which is public. It means that other countries may not want to deal with Canadian banks or offer correspondent services to be able to move money back and forth. It may be increased costs to do business globally, which would negatively impact our economy. And to the harshest, it can be sanctions against Canadian banks and businesses. So the Department of Finance within Canada is responsible for creating the regulations. So it isn't FinTrack, it's actually the Department of Finance. And they consult with stakeholders, and part of that committee is one that I sit on in Ottawa. And they obtain feedback to drive amendments. But ultimately what they are trying to do is meet the Financial Action Task Force's requirements. So they're working up. And FinTrack enforces the regulations. So although they're the face of AML and the people that everybody thinks is the anti-money laundering pain, they're actually really the messenger. So when they come knocking on your door, you know, being more angry at Department of Finance. So there are other informal stakeholders as well, and those would be local government trying to deal with the issues that face them, provincial regulators and associations. The media is a big one, banks, because they provide you guys services, and consumers. So a question to think about is, as a consumer, would you want to deal with a business who has not met its corporate requirements or has had very negative media coverage regarding its business and ethical practices? So when you hear about these types of businesses, do you wonder, how are they still going? They got in trouble. You know, why would people still want to use them? So keep these thoughts in the back of your mind, because this is the power of reputational risk, which can be far more costly than just a fine. So back in 2015, the Department of Finance undertook creating a risk assessment for Canada. And they looked at various types of crimes which had financial gains and would therefore need to have those funds laundered. And then they kind of plotted those against various different industries. So looking at this list, I'm sure that you're wondering what wildlife crime has to do with real estate, and actually it's not a whole bunch. But as the numbers go up on that chart, you'll notice that the severity of the crimes which are generating this dirty cash goes up. So these crimes are serious, and they impact everybody. So for example, by the time we get to number 6, we're looking at robbery and theft. Number 7 is funds obtained through the crimes of human smuggling, so people getting moved in across the border. Number 8 is even worse because it's smuggling and trafficking. So this could be the human trafficking that we're beginning to hear more and more about. Mortgage fraud, securities fraud. Number 9 is the illicit drug trafficking, the organized crime, grow-ups, bribery, corruption. And although we don't like to think of these things happening in our backyard, it is to the tune of about $65 billion a year, which is about 4% of Canada's GDP. So as I said, they took these different risks, these different crimes, and they plotted them by profession. So on this chart, the little black squares are real estate representatives, developers, brokers. And you'll notice that the real estate developers and representatives are viewed as riskier than accountants, which is M&P, but not quite as bad as lawyers. So, be thankful for little things. But this brings to light another issue. Lawyers are not covered under the requirements due to an ongoing legal battle. They've implemented some identification requirements, but it's not really viewed as sufficient. So as you can see, the real estate sales from illegal reptiles or birds is quite small compared to that that's derived from smuggling, trafficking, bribery, corruption, and illicit drug use. So it's really getting up there on the risk scale. So by now, hopefully we've convinced you that there's a real need for you as real estate professionals to take notice of these risks and ensure that you're doing your part to identify and deter money laundering activity. We're not saying that every real estate deal involves criminal funds, but what we're saying is the real estate sector has been identified as having a higher risk of being used to launder criminal proceeds. So again, the FATF report, so in November 2015, the International Monetary Fund and the Financial Action Task Force did their review of Canada, and the report was just released, so this is very timely. And I pulled out a couple of sound bites from the report, and I pulled out ones that were particularly pertinent to the real estate sector. So again, it's not necessarily saying that real estate transactions are bad, but overall it's saying there needs to be more attention paid to the sector. So what attention really means is more scrutiny. So what they're saying is that FINTRAC needs to develop sector-specific expertise and apply more intensive supervisory measures. That's more reviews for you guys. It's talking about awareness. So the FIs, that's going to be your banks and credit unions, they kind of moved along in their maturity. They know what they need to do. But the non-financial sectors, they're still behind in their awareness. So that includes the real estate sector. So supervision of the real estate and dealers in precious metals and stones, that you guys have been lumped together with the dealers of precious metals and stones, is not entirely commensurate with the risks in those sectors. So what they're saying is the regulators and other entities have not really identified the appropriate risk for the sector. More intense supervisory measures, so this keeps coming up. And one thing that's concerned them is the low number of STRs received from the real estate sector. So again, just to cover off what Lee was talking about at the beginning, there has been media coverage of real estate, and I just pulled things from the last couple of months. And it doesn't really show any signs of slowing down. So Vancouver-based lawyer wants inquiry into real estate money laundering. Vancouver real estate used for money laundering, international agency says. So that international agency is actually the Financial Action Task Force. Hotbed of Chinese money laundering, vulnerable to money laundering. It's fueled by money laundering. So there's definitely a theme that's going on. And as a result of the attention, provincial governments are taking notice and starting to make changes. There was end of self-regulation. So Michael Noseworthy has just been appointed as the province's new superintendent of real estate. There's been an imposition of the 15% foreign buyer tax. There's increased scrutiny by FINTRAC. So, the FINTRAC is saying that, there's nearly 500 real estate firms that they've done reviews on, and there are significant deficiencies. So all of these things are driving our presentation today. So I thought that we would start with the worst case scenario, the fines, so what it's going to cost you if you get it wrong, and work our way backwards with how to avoid them. So this slide I know is quite wordy, but I wanted to make sure that as the presentation becomes available to you, you have all the information in front of you. So to break it down and make it a little bit more friendly, if you like, I kind of view the administrative Administrative Monetary Penalties, or AMPs, like parking tickets. So you park too long or in the wrong place and you get a fine. In the AML world, you didn't keep a record or you didn't file a report, and each action described on the AMP menu has a price tag. So when FINTRAC conducts examinations, they can apply the AMP based on the outcome of the review. So for instance, using simple math, they look at 100 records where occupation hasn't been collected where necessary. And while this is considered a minor infraction, the fine could be 100 files times $1,000. That's $100,000. So if you've missed filing suspicious transaction reports, this is considered very serious and could have a price tag of $500,000 for each missed report. So not to be viewed as alarmists, FINTRAC to date has not tried to put entities out of business, but they are trying to show the international community that they have respect and attention of the reporting entities in Canada. They're trying to show that they've got some teeth. So in the past, fines have been reduced based on the ability to pay, the seriousness of the offenses, and the willingness of the reporting entity to mend their ways and show improvement. So what they do over and above the fine is name and shame. So this is where if you get a fine, your name goes on the website for 5 years showing what you did wrong, what your fine was. Anybody can go and look at this. So this is the damage that can be done to an entity's reputation, and that can put them out of business. So the criminal penalties result when FINTRAC has tried to work with the entity and they're not getting any cooperation, they're not getting anywhere, and there isn't a reasonable time frame that they think that the entity is going to come back into line and be compliant. This is less likely to happen in the AMPs. To date, this has not happened. We hope that it never will. But certainly the implementation of the AMPs back in 2008 took away some of the requirement for the criminal penalties because FINTRAC can slap the fines. So in the real estate sector, up to July 2016, there was 12 entities that had been levied $113,000 in fines. This represented about 15% of the entities fined in all sectors and only about 5% of the total. So that doesn't include the $1.5 million fine, which was the largest fine in Canadian history against an unnamed Canadian bank. I don't think that smaller businesses, real estate, money service businesses will get the same treatment and not be named. So with the number of real estate examinations and the cited deficiencies, the pressure from local governments, the money laundering rhetoric that's coming up in the media, this number is expected to increase, and it's also expected that FINTRAC is not going to want to lessen the fees. They're going to want to start making examples. So what I wanted to do here is draw a little bit of a comparison to money service businesses. So both are covered entities now. Both started to be covered back in 2008. And money service businesses were kind of the ugly red-headed cousin. And they became, there was tremendous bad press about how MSBs were money laundering hotbeds. Everybody that wanted to do something bad was going to go through a money service business. There was bad press. The FATF report, the previous one, it was MSBs need more supervision, they need to be regulated, they need to be this. But there wasn't so much talk about real estate. So even after the introduction of registration with FINTRAC back in 2008 and the requirement to have a compliance regime, the MSB is still not a welcome player at the table of the banks. So banks are concerned about guilt by association, so bad money going through the MSB to get to them. And they took and continue to take actions to avoid any reputational risk that could be passed from the MSB to them. So this includes blanket de-risking or demarketing of MSB accounts. I am going somewhere with this, I promise you. So this can sometimes extend to the owner's personal accounts, mortgages, loans, credit cards, so anything to do with the ownership of that money service business. So at times, when a money service business has been kicked out of their bank, they find it very difficult to find another one. And that relationship is always unstable because as soon as anything happens, that bank is very quick to, again, close their accounts. So from what we're hearing, banks and credit unions are beginning to look at real estate in the same way. So this could mean that similar requests to close accounts are coming from banks. It can also mean that there are requests to make real estate brokerages, developers jump through many, many hoops, which could be over and above the regulation. So it's kind of good to get in front of those requests and be able to show that you know what you're doing with regards to your AML compliance. So I just wanted to raise that to kind of look at the similarities so that you guys see that there is a real push to be able to get the awareness levels and the compliance programs together. So putting all the negativity aside, whether you're a small, medium, or large developer or brokerage, negative press can affect you. So what are we going to do to try and make this better? So understanding the obligations placed on you as a reporting entity, making sure that your firm isn't being unwittingly used, which could tarnish your reputation. Implement a robust compliance regime, not just have the documents, but actually implement them. Know your clients and ask questions. Report when appropriate, keep required records, and complete your independent biannual reviews. So just to kind of put it out there, I've got a couple of slides here to kind of break things down to make things clearer. So you've got your compliance regime, customer identification, record keeping and retention, and transaction reporting. As we mentioned before, the firm is responsible for the compliance regime. You as an individual broker don't have to have your own policies and procedures, but you do have to participate in that client identification, the record keeping, and the transaction reporting. So I look at this very simply as the who, what, when, where's, whys, and sometimes hows. So the compliance regime is the why you're doing something and the how you're going to meet the requirements. The client identification is the who you're dealing with. The record keeping is where am I going to keep these records and how long do I have to keep them before they can be destroyed. And the transaction reporting is the what. What's going on that appears suspicious that could be tied to money laundering activity. So there are day-to-day requirements, which are obviously going to be dealing with your regular, your business, so dealing with your clients. Then there's going to be the compliance program, which goes towards the fulfillment of the responsibilities of the firm. And then there are levels to check and assess whether the compliance program is working. So again, no matter how big or small your operation is, all of these things are required. So I wanted to start with when do you actually need to identify a client, because this will trickle down to a number of different things that you do. So there are certain triggers that will occur that will require you to ascertain the identity of your client. So namely any purchase or sale of real estate, receipt of funds, that could include large transaction, which I know are rare for you. So large cash transactions would be $10,000 and over. And if something is fishy and that you should take steps to establish the identity of your client without tipping them off, and we'll talk about that in a few minutes. So ascertaining the identity means obtaining proof of who your client says they are. So this can be through seeing in person a government-issued ID, such as a driver's license, a passport, or similar piece of ID. The ID needs to be current, so it can't be an old passport or an old driver's license. It has to be current. And if the client isn't in front of you and you haven't been able to meet them face-to-face, perhaps you're working through a company in an offshore jurisdiction and the client hasn't come to Canada, then there are other procedures on how to identify them. So getting a copy of the client's driver's license or passport faxed to you does not meet the requirements. So the records that need to be kept are the large cash transaction reports, the receipt of funds records. So the difference between these two, as I mentioned, the large cash transaction report would be somebody gives you $10,000 or more in cash. The receipt of funds record is any amount, no matter how much. So if somebody gives you a check for a down payment, a receipt of funds record is required to be kept. The client information records need to be kept. Copies of official corporate records. This would be, again, if your client is a corporation or another business. Copies of suspicious transaction reports. Although there's not very many, hopefully going forward there'll be a few more. Records of the purpose and intended nature of your business relationships. This is when you enter into a business relationship with your client, and we'll touch on that again because this is a new requirement as of February 1st, 2014. It's created quite a lot of confusion. And of course, we have to keep records on the measures you take to monitor your business relationships. So with regards to the large tax transaction and the client information records, there's also a requirement to determine whether or not the transaction is being conducted by a third party. So this is somebody else directing the actual transaction. So somebody is telling a front person that they need to buy it. The money is going to flow through this third party, but the only person that you ever see is the third party. So you have to take measures to ascertain whether or not there is somebody like that. So generally, records are kept for a minimum of 5 years from the date the report is created, in the case of an LCTR or a receipt of funds record, or 5 years from the date the transaction is completed, or the business relationship is ended. So a business relationship is 5 years. So if a client has entered into a business relationship, you don't see them for 5 years and a day, they come back to you, you're starting again. Of course, you may want to look at the relationship that you have with your client and still make assessments. So getting into the suspicious transaction reports, which is one of the areas that FINTRAC focuses on. And I know that it's difficult for you to think of a client or someone that you know is suspicious. But sometimes when you look at what you know of a person, you realize that you don't know that much. So a suspicious transaction report or an STR report that's made to FINTRAC only has to have reasonable grounds to suspect. Nobody is expecting you to do a massive investigation and follow the client and figure out who it is that they're dealing with, or you've seen money pass hands. It just needs to be a reasonable ground to suspect that something isn't right. So reasonable grounds are really as simple as saying, would another person think that this transaction is unusual? So again, it's not proof that you're looking for. It could be that the amount that the client is purchasing is, the property value is not in line with their occupation, and you can't get information to make that less unusual for you. So your client must not be told that you're filing a report. This is called tipping off, and it can be a criminal offense in itself. And even if you're incorrect in your assessment, as long as you've provided that report in good faith and have articulated your concerns, nothing negative is going to happen to you or your firm. So just as an example, for instance, you may know that the person's name that you're dealing with is Bob Smith, and he says that he's a student. So I've kind of used kind of the grandest examples that I can just to illustrate. They may not all be this blatant. So he's told you that he recently came to Canada to study. And when you close your real estate purchase, Bob gives you a bank draft drawn on a foreign bank for the full amount of the purchase. And you wonder, or you should wonder, where did a student get the amount of money? And why would a foreign student want to purchase a home in Canada when they're on a student visa? So in an instance like this, some additional questions should be asked. Is the home mortgaged in your home country? Can you verify the mortgage documents? So you would want to actually have a look at these documents. What are your plans once you've finished your studies? Do you have job opportunities here, which would lead into kind of the conversation about what they're studying? Are you also working in Canada? So how are these mortgage payments being made in the home country? And will the student visa allow working to be done? Because one of the pieces of information that you have to gather is occupation. So is student actually the right and correct occupation, or should it be something else? So if you can't get the answers to these simple questions, or it appears that the person you're dealing with is the front person, you may want to try and determine who that third party is. And if they say, oh yeah, I'm actually buying this house on behalf of my parents who are coming over, there's just information that you need to gather. So if you can get the answers, the person is prepared to give you the information, there's nothing wrong with that. And now that transaction isn't unusual or suspicious. So the basic rule of thumb, as I said, is if you were to tell another person this story of, hey, guess what happened at the office today, and told them about the transaction, would they raise an eyebrow and say, huh, how does that work? And I'm sure that you guys will remember recently in the papers in Vancouver, there was cases of students who, or a student, who had purchased a home for goodness knows how many millions, and there was no money that, or no source of income that had been verified or that was apparent to be able to pay for this home. So never tell your client that you're going to file a report. And again, you're protected when you file a report. So another piece of information in the regulations that can sometimes be confusing is this requirement to file attempted or completed transactions. So a report needs to be filed if it's suspicious on both completed, that's kind of easy, the sale has gone through, or an attempted transaction, which is one that would have gone ahead, but by you asking for additional information, the person is backed out. So the FATF report indicated a concern that there were very few reports from the real estate sector. So this means that FINTRAC is going to come and look and review for effectiveness. So a misreport, as I stated earlier, is a maximum AMP of $500,000 per instance. That's a lot of money. So the way that FINTRAC does this is they will look at your data, or they'll look at your files, and they can say, hey, this looks weird, this looks strange, I think this is a misreport. And unless you've got information to be able to say this is why it's not suspicious, they could tell you that you've missed a report and give you that fine. You certainly don't want that. So regulations require reports on transactions that are both completed or attempted. So as an example, a potential buyer calls your office and wants to be shown houses that they may be interested in purchasing, but then after they've wasted your Sunday afternoon, they don't want to put in an offer. This wouldn't be considered suspicious. There's no transaction. There's no purchase agreement. If a purchaser wanted to put in an offer for the property and it's countered by the owner and the purchaser doesn't want to get into that bidding war, this again wouldn't be considered suspicious. I would consider it quite wise, but it's not suspicious. But a client who's shown interest in moving forward with an offer and then doesn't want to provide the information for your client information file and declines to move forward based on that should be reviewed for red flags, which we're going to touch on in a minute. And that file should be reviewed as potentially a suspicious attempted transaction. So to take that example a little bit further, so a client who has declined a transaction with you when he's asked to show ID has moved forward with another agent within your firm. Obviously, you wouldn't know if they've gone to somebody else. And they have completed the transaction. So in my opinion, that should be reviewed to ensure that all details of their identification has been collected and verified. And for instance, when dealing with that second agent, did the client use a corporate or a corporation or a trust rather than their individual identification that would obscure the actual ownership of the purchase? This, in my opinion, would be a potential STR. So just as kind of a tip and something to consider, it may be beneficial to implement a process within your firm where any unusual transactions are referred to your compliance officer for review and independent determination regarding whether the report should be filed. This will assist you with record keeping, consistent review, risk assessment, and oversight. And this should include deals that have been canceled or backed out of to determine the reason and whether an attempted STR should be filed. So what are these red flags that we talk about? So there may be some scenarios that we go through here that seem quite commonplace because they're the types of transactions that you may be dealing with each day. So in the real estate market, don't get complacent just because of the type of clients that you're dealing with. Take a step back and again, ask yourself, would the everyman think that this is still commonplace? So it could be things like client purchases property in someone else's name, such as an associate or a relative other than a spouse. Client doesn't want to put his name on any of the documents that would connect him to the property. Client pays an initial deposit with a check from a third party other than a spouse or a parent. Now keep in mind, we're not suggesting that a client is always doing something bad. Perhaps in the case of the check coming from a third party, the client may have received a settlement from an insurance company or something like that, and that's the explanation. Once you've got the explanation, then you don't have a suspicious transaction, as long as it's verifiable and makes sense. So maybe the client pays substantial down payment in cash and the balance is financed by an unusual source. The client purchases multiple properties in a short amount of time and doesn't seem to have very many concerns about the location, the condition, and anticipated repair costs. This could be the clients are buying homes that they could be used to make more illicit funds, grow-ups and such, or they're looking to be able to channel a large amount of cash into renovations. Client insists on providing signature on documents by fax only. This is where we get back into that third party kind of scenario where they need to have the third party sign the forms to make sure that they have ownership of the property. Client wants to build a luxury house in non-prime locations, and real estate is all about location, location, location. But as you know, you can overdevelop for a particular area. So does it make sense that this massive house is going to be built in, downtown Maple Ridge, for example? So if a property is resold shortly after purchase at significantly different purchase price without the corresponding changes in the market values, these are all things that potentially should be looked at. So just for real estate brokers and sales representatives, the client sells the property below market value with an additional under-the-table payment. This is what we were talking about with the undervaluation. Client purchases property without inspecting it or even seeing it. They just say, I'm looking for a home in downtown Vancouver, and go out and find it for me and I will pay whatever it is. Client is known to have paid large remodeling or home improvement invoices with cash. So all of this types of things should start to kind of get your spidey senses going. There are many, many, many more red flags, but in the essence of time, we'll move forward. And if you guys want to talk about more red flags, we can certainly do that through the questions, or you can give us a call. So if, as we were walking through these red flags, you were thinking, oh, that sounds like Mr. Smith or Ms. Jones, I encourage you to go back to look at the transaction with an independent view to determine if a report should be filed. So timelines for reporting STRs are 30 days from the date the transaction is deemed suspicious. So if today something made you start to think about a transaction that may be unusual, when you go back and review and determine that it's indeed suspicious, you need to report it within 30 days. So we had touched on business relationships when we were talking about client identification. So a business relationship is a relationship that you establish with a client to conduct financial transactions or provide services related to those transactions. And you hit that business relationship marker when you conduct two financial transactions where you have to ascertain identification. So this would be independent or an individual identification, or confirm the existence of a corporation or other entity. So if you remember back in the presentation, we had said that where you need to identify clients and get their identity is when they purchase or sell real estate, when you fill out a large cash transaction, or when you fill out a receipt of funds. So once you've entered into that business relationship, then you also need to do ongoing monitoring and risk assessments. So higher risk customers, maybe there's some that have hit some of those red flags, they would need to be looked at more often, particularly if they're active clients with you. One of the last requirements is scanning for terrorist property. So there's two situations that can trigger the requirement to send a terrorist property report to FINTRAC. One of those is if you know that the property is owned or controlled on behalf of a terrorist or terrorist group, or you believe that the property could be owned or controlled. So how would you maybe come to the conclusion or believe that the property is owned or controlled? It's looking at official lists. So two of these lists are, one is on the public safety website, and the other is on the OSFI website. So most people use the OSFI website. So when you ascertain the identity of a client or get third-party information, you would want to just have a look at the names on the OSFI website to make sure that they're not a listed entity. Obviously, there are more listed names from certain parts of the world than others. So, potentially you're not going to be having to check every name. So if you do come up with somebody on the list, then there's reports that need to be filed not only with FINTRAC, but with CSIS as well, because it would be national security. And it should be marked very, very clearly that you've got a potential match to these names. So we've gone through kind of the day-to-day requirements, the identifying your clients, the keeping records, the having your business relationship. But all of this rolls up actually to the compliance program. So the compliance program is really the meat and potatoes and the how, amongst other things, you're going to meet the requirements. So there's 5 pillars with regards to the compliance program. The first is appointing a compliance officer. This is typically the managing broker, or it would be the managing partner at a development firm. You need to have written and up-to-date policies and procedures. So this again is the what and how you're going to meet the requirements. You need to assess the AML risks associated with your business, and you need to put into place mitigating factors for high-risk practices. You need to implement and document a training program for your staff, and if you're dealing with agents, to take ID for them as well. And you need to test the program. You need to make sure that it's effective. So within the policies and procedures, you need to touch on suspicious transaction reports, the terrorist property reports, the LCTRs, as well as the receipt of funds, the record keeping, the ascertaining identity, the use of personal information, business relationships, and third parties, all of which we've talked about earlier. So there are resources to help you gather the information to create the required policies and procedures, the training and the risk assessments, and these can be found on the fintrac.gc.ca website, or through CREA, or the Real Estate Council of BC, or the different provincial real estate councils. So the documents typically from these different resources will outline the requirements. But one thing that's very important is that you need to bring these back to you and adopt the requirements into your business. So for example, the CREA document may say, FINTRAC requires that a large cash transaction is reported within 15 days from the date of the transaction. When that becomes your policy and procedure, it would say, Company ABC is committed to reporting any cash transactions of $10,000 or more, and this will be done no later than 15 days after the transaction date, and this is how we do it. So, it's not saying that you need to make the documents wildly complicated and have words coming out of everywhere, but it needs to state, this is what we're going to do, and this is how we're going to do it. Assess your risks reasonably and implement actionable steps to mitigate the risk. So again, as kind of a big cartoon example, you state in your risk assessment that your risk tolerance overall is a low to medium. So you're not wanting to be a really high risk brokerage. However, your business is focused on clients who want to pay cash. So based on the risk of money laundering, the inherent risk of your firm being used to launder funds when the clients that you want to target are dealing in cash is very high. So there are really no controls other than discontinuing that practice that will lower your risk. So then you need to make a business determination based on your risk tolerance of what you're going to do. So ultimately what you're trying to do is match the activities that your business is doing to your overall risk tolerance. So there's a lot more intricacies in the compliance program. I could very happily talk about this for weeks, but I know that we're getting to the point where we need to wrap up. And one of the things that I wanted to touch on was when a stranger calls and FINTRAC comes knocking on your door. So FINTRAC compliance officers can enter your premises where the business operates. They can use any computer systems or data systems where information is stored, and they can use any equipment on the premises and take copies of documents. And you will say thank you and be very nice to them and give them coffee. So the criteria for being examined is really, eventually all real estate companies will be examined, similar to banks, credit unions, casinos, money service businesses. This is just part of the FINTRAC life cycle. Obviously, with the media, the press, the FATF report, there is more appetite for FINTRAC to come knocking on real estate companies' doors. So that's both brokerages and developers. A percentage of firms will be re-examined. We know that there's been a number of exams done, so they will get back into the cycle and will be re-examined. Just because FINTRAC has come knocking once doesn't mean that you're done with them. Chances of FINTRAC coming back, if they've identified issues, they're going to want to come back and make sure that you fix them. So timing for that can be anywhere from 6 months to 3 years, depending on the severity of the deficiencies that they found. So there are 3 types of FINTRAC exam. One is a compliance assessment report, which is really a, hey, do you know who FINTRAC is? These are very uncommon now, particularly when real estate agents and developers have been covered since 2008. We're going on for almost a decade. Hopefully everybody knows who FINTRAC is and what their obligations are. The desk exam is when you provide all the documents requested to FINTRAC and they look at things off-site and will send you a letter and tell you what they think. The on-site exam is more common. And sometimes it can be a combination of both the desk exam and the on-site exam, where you will submit, when the phone call comes and the date's agreed, you will submit your policies and procedures, your training, your risk-based approach, any independent reviews that you've had done over the last 2 years or further back, depending on the scope that they're looking for. But then they will come on site and they'll look at your data, they'll look at your STRs and determine if you've got any issues there. So what does the timeline look like? So from the date that the examination notice comes in, so this can be a letter or it can be a phone call that's followed up by a letter. It can be, say, 15 to 30 days before you've got your document submission, the exam is set, and they actually come and visit you. Then typically it's 30 to 45 days after that that you get a deficiency letter or a findings letter, which sounds much more friendly. Hopefully we never get to the second layer, which would be you've actually done something wrong, they want to fine you, you can appeal that, and then there's a response that happens. So, you know, if we focus on the top line, it's much more friendly. So how do we make sure that we're prepared? So in my opinion, you should always be FINTRAC ready. So preparation starts before the notification call from FINTRAC. Because ultimately you can't go back and do your effectiveness reviews if you haven't been doing them. If you haven't got records or you haven't retained them, you can't go back and get those. So we need to make sure that, you know, as of today, you're starting to get ready for these calls. They will be coming. You should be looking to see if you've got or if you know of material deficiencies that should be assessed for self-disclosure. Once that phone call comes, even if you know that you have no records, you can't say to FINTRAC, hey, you know what, we've got a problem, because they're going to view that you wouldn't have told them if they weren't coming in to see you. So it's one of those things where it's better to fess up and work with them than for them to find that something is terrible and horrible. So I have always found FINTRAC to be really quite reasonable. So if they say the date is going to be such and such for your review and you know that you're going on the holiday of a lifetime and you're going to be on a Disney cruise, you may want to say to them, hey, you know what, the compliance officer for the business is not going to be in the office at that time. Can it be the following week? Obviously you can't put it off indefinitely, but certainly you can set a time that's going to work for you. So with all of this, as we wrap up, how can M&P assist you? So we've covered a lot of information today, and I know that there are many different developers and brokerages at different places in their compliance lifecycle. Some have used existing resources to pull together the components and are wondering if it's enough. And we can certainly assist with a gap analysis of the program to the requirements to provide you with areas that need to potentially be enhanced. At times, reporting entities like to take this approach before a full review, particularly if they're starting to get questions from their bank. They don't want to show a full-on report that's got all types of deficiencies. For entities that are a little longer, further along their life cycle, you may be ready for your biannual review, but you don't have an internal audit department, or you don't have a group that's independent from your compliance person or department to assess your program. And we're able to provide this review service to meet the regulatory requirements around the effectiveness review. Training is a core component, and we can certainly tailor training to meet your needs, whether it's on specific FINTRAC requirements, whether it's on customer identification or red flags, we can certainly help you with that. When FINTRAC does come knocking, we can help you prepare the documents requested, sit in on the examination, and help guide you through it. So once the finding letter has been issued by FINTRAC, there may be work to do, and we can certainly assist with reviewing files, procedures, and help you remediate different issues, gather information, set up record-keeping processes. And if your compliance program is even more mature, you may have instances that through your own ongoing monitoring of the program, you do realize that something is wrong and you need assistance with doing that self-disclosure to the regulators. So if you have questions or you feel that you need to talk to somebody about where you are in your life cycle, please don't hesitate to reach out. So with that said, we have people in offices across the country. So I'm in Vancouver, Megan is in Calgary, and Jennifer and Dave are in Toronto. And we certainly look forward to working with you in the future. And if you have any questions, either feel free to reach out through the real estate niche contact or your usual MNP contact who can connect us. So as mentioned at the beginning of the webinar, hopefully you've been madly putting in questions into the webinar platform, and we're happy to deal with these. And as I said, we found it to be beneficial doing these different webinars to be able to answer them in writing on through a blog on our website, and that way you have another area to reference. So we will aim to have that up kind of in the next week. So I would like to thank Lee again for his insights from the real estate and construction perspective, and Greg with his perspective on forensics, valuations, and litigation support. And I would like to thank all of you who took the time to join us this afternoon. So if you miss any of the content today, just a reminder that it is recorded. I know that it's a lot of information, so sometimes hearing it for a second time helps. And we will be making it available for playback in the days ahead. So thank you once again for joining us today, and we do look forward to hearing from you. Have a wonderful afternoon.